Welcome out to Tackle Trading's halftime report, where we will break down the market indexes. We're going to talk a little bit about sector rankings today. We're obviously going to go through some stocks in the news. We got some AMD news and as well as some Berkshire reports to talk about. And then we're going to get into a new Ginos Gem where he's going to talk about how you can easily categorize your watch list by the RSI, so you can see where the RSI is relative to your watch list. And so I'm excited for another edition of Ginos Gem. But before we get into any of that, very quickly, ladies and gentlemen, we got another edition of Tackle Trading's 101 series that is going to be here tonight. The great Coach Greg is going to be with us later on tonight, where he is going to be breaking down market funds, talking about it. It's a very basic topic, but for a lot of traders that are finding tackle trading, they're newer to the marketplace. And so he's going to discuss the differences between types of funds, index funds, exchange traded funds, mutual funds, the differences, the similarities, where you can take control and why you should embrace ETFs. And so I'm looking forward to another edition of Tackle Trading's 101 series. It is every other Monday here on Tackle Trading's YouTube channel. So here is the link. They will provide it in the chat as well. But get excited about Coach Greg later on tonight. I'm very excited. I have the pleasure of doing his introduction later on tonight as well. So get excited for that. But until we get to that, we got a lot of stuff to talk about in the market. I got great coaches here, Coach Gino, Coach Mark. Let's start with Coach Mark. Mark, how you doing today?
I mean, how do you not be good at right now, like, in this market? Like, oversold conditions, but man, things are ripping, right? And the strength of the SPY, I mean, I don't even think tells the story of the whole market, how like good it is. I oftentimes will chide over the course of 2021. Yeah, directional traders have a rough time. Cash flow traders having a great time. Listen, cash flow traders, we're doing all right, but directional traders are killing it out there. Well, they're absolutely killing it out there.
But isn't that the benefit when you get these types of parabolic movements as a shorter term trader taking on the directional risk? You kind of get that added benefit of taking advantage of that. Whereas the cash flow traders, they compound all the time. So I'm not gonna lose sleep for you cash flow traders only making a little bit of money. It's a good problem.
I mean, this has been one for just the history books, and who knows where it stops too, right? A little lull today, and I'm sure we'll break down the technicals here in a second. Mm-hmm. But the one thing I have, in this environment, you don't know where that momentum ends. I mean, you just go look at charts, go look at Nvidia, go look at Tesla. Mm-hmm. I mean, one day the momentum will end, right? Will it end tomorrow? Will it end 6 weeks from now? I don't know. But I do know that, man, there are a lot of opportunities in a lot of areas. It seems like everything's working on some level right now, as long as you're not named Peloton.
Here's rule number one as a trader. When the cash flow traders are complaining they're not making as much money as they want to, it's usually a really good time for every market participant in the market. There's no doubt about that. Let's bring on Coach Gino Port. Gino, how you doing today, my friend?
Great, Matt. You couldn't have said it better, Chucky. I mean, it is a trend traders market, and going with strength is where it's at. It's not a bottom fisher market. No, it's not. That's over.
It is not a bottom fishing market. No, and that's a good observation too, because I love bottom fishing. I don't even think about bottom fishing. This plays strength. If you're a broken story right now, I'll revisit you when this time period in the market history ends and see if there's some value out there. Right now, it's playing into strength. What's strong? What's got momentum? Let's play in that field.
And one thing to keep in mind, when you're talking about those stocks that have been beaten up, obviously they've recovered a little bit with the market. But don't you feel like their recovery has been because of the strength of the market and not in spite of it?
Yeah, I mean, I'm sure there's a story or two out there somewhere.
My point is, the point I'm trying to make is where you really see the value argument playing in is when you're talking about certain stocks, certain sectors, certain industries at the low points of their charts the market's struggling a little bit. That's not what is happening in this marketplace. This marketplace is based on growth. And when you take a look, before we break down the actual indexes here, let's talk a little bit about causation, because over the course of the summer and coming into really that August-September timeframe, we were so enthralled with talking about tapering and what the central bank was going to do. We were coming out of earnings in July that were pretty hot, but we had a July, August, September coming into October timeframe that the market at best was mixed, and at worst we went through some type of bearish downtrend as well. And so you really didn't have, and for a long time, Mark, ever since we lost that, the economy reopening up theme that was tied to the vaccine, that was really dominant from really about a 6-month stretch from November last year to about April, May of this year. Ever since that time frame, you really have not had a positive theme to really have the market attach itself to. But from the start of earnings season on, you've really seen this market start to understand and appreciate the growth component of the marketplace. And right now with earnings, and again, where we started earnings season, right here, guys. This is where earnings season started. This is where earnings season has ended. And so you came through this environment where it was very difficult from a market participant perspective. You had a nice tight reversal pattern in the market that was happening at the very beginning of earnings season. Remember that financial reporting week, it put in a bottom, and then ever since we broke out, it's just been ride that momentum up to the top side. Well, that was attached to what was happening with earnings. And remember, 4 weeks ago now, I sat here in the halftime report and I said, guys, if there's one number to keep an eye on over the next few weeks, it is the blended growth number. And what you've seen in the last 4 weeks, if you've seen that go from 27.5% to 29.9% to 32.7%, and right now, after 89% of S&P 500 companies have reported earnings, you right now have an environment where 81% of them are beating EPS numbers, 75% of them are beating revenue numbers, which is very good against the 5-year average, but not very good against what has happened post-pandemic. I'd say it's actually a contraction. But when you look at blended numbers from both a revenue and an EPS perspective, and what blended numbers take into account, remember, the number we were looking at was 27.5% 4 weeks ago. That was the blended EPS number. That number at the time took into account a very few actual reports because we hadn't even seen the financial reports yet. And then it took into account all the expectations, right? It took into account, well, we expect Apple to do this. We expect Facebook to do this. We expect AMD. Well, so far, guys, we've had companies, 81% of those companies have beat the EPS expectation. And what we have seen in that environment is EPS blended growth went from most companies that were expected to do something to now what they have actually done. And they went from 27.5 to 30% to 32.5% to a whopping, after last week, 39.1%. We're talking about explosive growth potential over the course of the last 4 weeks. And you're looking at a revenue expectation that went from 15% 4 weeks ago to now 17.5%. And so this market, we're all looking at this market right now saying, oh man, it's one of those markets that's just so beautiful, beautiful. Well, it started with the analysis during the reversal. It started with the analysis of where we're at from a fundamental perspective. And then as we have worked our way through earnings, those numbers week after week after week have done nothing but improve. Not greatly, but have improved over and over and over. And this market has adapted that theme as we're going into, obviously, a seasonality condition where we typically do see a little bit of stock appreciation. So I'm not shocked that the market has recovered, and I'm not surprised in the slightest that we're forming a little bit of a bullish uptrend. I am a little shocked we haven't seen any type of flag-based pattern. We haven't seen any consolidation yet. We haven't seen a secondary pattern. We see them all the time in sectors. We see them all the time in industries. We see them all the time in individual components of the market. But as for the market itself, we're on this methodical grind. And I think the question at this point is, how far can this go without it having some degree of correction. Where is your head at? And I'm going to go to Coach Gino. Where is your head at right now, Gino? You're going to be talking a little bit about RSI a little bit later today. RSI, relative strength indicator, anything above 70 is a typical sign of slight overextended, slight overbought condition. Right now, we're being at a 90, guys.
No, you know what's funny, man? I didn't know Gino was going to do the RSI.
I didn't know either.
I literally put the RSI on my charts for the first time in a long time because I respect the indicator. You know, I'm a moving average guy, but I'm like, listen, everything's so above moving averages right now. They're not.
And that's kind of my question. I want to get both of your take on it. So the same question to both of you two fine gentlemen. With the marketplace overextended in the short term, but like what feels like frothy buyers mentality out there, how do you handle a market that certainly is in a buyer's mode, but is at elevated price thresholds to the point where we are looking at a fairly overextended environment right now? I'm going to go to Gino first.
Yeah, so Matt, this is where you get the nerves of, okay, am I missing out and I need to jump in, or is it too late? Like, is it overextended? Am I chasing the trade? You know, am I going to jump in at the top, which is a very big fear. I just heard, first thing I heard on the news today, a big money manager and broker out there saying, wow, the market's on fire. We're killing it. We're just rallying the last month and a half, and everything's up across the board. Yeah, that's great if you have a 401k, right? You've been investing and you're hearing that news. That's good news. But what if you've been sitting out and now you're like, okay, do I jump in? So this is where, you know, if you get into the newsletter, I talk specifically about this, is at the end of October expiration, I said, look for those bullish signals that the market's going to do that fourth quarter rally. And this is typical. This is your typical November rally. I put a big arrow on it for what happens in the last 20 years. I put a seasonality thing. This is your typical November rally. And with that said, it usually does get overheated in the middle of November, which we're approaching. And usually around expiration, you know, third week of November here, usually we have a pullback. And it's a slight pullback to test. So yes, I would like to see that pullback. So if I'm missing out, I will wait for that pullback and then re-enter. But if I'm already in the market, you do what all traders do. You raise up your stop losses, you buy puts to protect your downside, you stay with the trend. So like Mark and I were talking earlier, because him and I think alike, because we're you know, credit spread, naked put, credit traders, theta
cover
traders,
calls, boomerangs.
Cover calls. Yeah. We like cash flow. We like selling options where the market's not going to go, right? We're not so much your directional trader because it's not as consistent. But when we say you got to go, when you hear a theta trader saying you've got to go directional.
So true.
You've got, I mean, that means it's bullish. Okay.
See, can I give you my take as a directional trader? Sometimes it makes me wonder if the freight train's over when the
theta traders come in.
like directional traders been nailing this, guys. Like, yeah. And honestly, I'm seeing a little bit of consolidation at the top, and I got to point something out, guys. There's an old cliche in the market for a reason, but it says, you know, it's the buy the rumor, sell the news here. And a lot of the price movement over the course of the last week and a half, it's been some positive earnings, but I would say more than anything, it was a lot of that news coming into an anticipated infrastructure vote, which we were going to have every single day last week. Literally every single day. And then on Friday, after the markets closed, we're all basically done. Friday late night, they passed infrastructure. I want to go to Mark very quickly, though. Do you have any concern, Mark, that we're now 3.5 weeks into this run without a retracement? We just got infrastructure, the $1.2 trillion infrastructure deal passed. That looks like it's going to go to Biden's desk here. Do you have any concern about buying the rumor, selling the news here now that we are post that $1.2 trillion infrastructure deal passing?
Like you know, I think it depends on the area of the market. Now, first of all, from a broad market standpoint, it's hard for me to get involved after massive runs. Yeah. Like, you know, if I catch a trigger clean, or maybe I'm a day late, you know, I'll get involved. You know, I mean, my personality type is once things take off, manage existing stuff, look for new opportunities. But like when you get into these conditions, like it's like, well, a slowdown's going to happen. You just don't know when it's going to happen, right? Could happen weeks from now. I mean, you don't know, but you do know. You've seen the song and dance before, right? You've seen the song and dance before, and it's just like, what kind of formation occurs, you know, on that slowdown? Do you just trade sideways for a week, a couple weeks, you know, kind of like oil did the last couple weeks, right?
I will tell you, as the directional trader in this panel here, I would love 4 days of consolidation and a breakout on top coming into the weekend. Like, and it's simply because we have yet to see a secondary pattern in this movement. And the reason I say that is I don't consider that a high base. It doesn't meet the time frame for a high base. It's a simple two-step consolidation in the, and so you've had such a beautiful run. And by the way, I think this is a stock picker's market, and if you see a trade, what should you do?
You should take the trade.
You take the trade, right? There's no doubt about that, because the market is a broad representation of everything. We have some secondary patterns within sectors. There's no doubt about that. We'll break that down here in just 1 second. But we are a little bit overextended. We did get some major news coming over the weekend, and we've had good positive COVID news as well from a oral pill perspective out of Merck, out of Pfizer as well. So it's going to be an interesting market over the next few weeks for certain. Let's talk a little bit about the separation of the indexes. And when you're looking at the S&P, you're looking at a methodical grind up where we have yet to even touch the 9 EMA. Just one quick point, you are looking at a little bit of intraday consolidation ever since Friday's blow off. And so you had Friday's blow off here. A lot of that was based on the overnight on the infrastructure. You really haven't seen any of that follow through. Here's the futures market open on Sunday right there. You haven't really seen any follow through from that. Could we see a little bit of consolidation, a little bit of hesitation, following again a little bit of the buy the rumor, sell the news type scenario? Stay with us in the halftime report as we break down this high base that could be forming in the S&P. But what has not been high basing is the Russell 2000. It's the one index out of all the indexes, like the S&P, the Dow Jones, the NASDAQ, all been doing fairly similar things over the course of the last 3-4 weeks. Here's the Russell 2000, though, obviously breaking out of intermediate, primary, and short-term trends. You know, Mark, we basically were nailing this 2300 break, talked about the 2350, 2360 break, talked about the 2400 break. This is obviously a shift in character. Even the staunchest individual that is anti-Russell 2000 would have to capitulate to this type of price movement. What is your technical read on the Russell 2000 and small and mid caps in general?
I think they got room to run, right? Because once again, it's one thing to analyze something that's blown off after 4 or 5 weeks, right? When something's blown off for 4 or 5 weeks and you're like, man, this is stretched, you know, and it's not, you know, there's never any guarantees, right? But
Yeah.
This feels like it's in the early legs of upward movement. You know, like once again, you go look at some of the charts over the last month that have ran. You know, if you would have said after 5 days, well, you know, it's had a good move, there was a lot more to run on it. This feels like it could be early on in taking that next level leg higher.
Gino, what's your take here, Gino? I mean, you're a cash flow darling, the same with a lot of people at Tackle Trading. You love iron condors, you love credit spreads on the Russell 2000 itself. With this recent breakout, how are you adjusting your cash flow philosophies to the small and mid cap index there? And you're on mute, Gino.
Oh, there we go. Okay, sorry about that. So,
you're fine.
At the Russell, this has been the cash flow darling, and the reason I say that, I've been commenting on this every week in the newsletter, how the Russell is staying in this range for the last 8.5 months, and all you iron condor traders out there are loving this. And we have a huge group of iron condor traders, guys. We call them cash flow condor traders. We have a course on it, and Tyler and I have been doing this for years. And we love it. That's one of our number one trading vehicles is the Russell for this. And this has been like a textbook strategy for this index, not the S&P, not the Dow, but for this index, because it has a pretty decent premium when it comes to options. It's got good strikes. It's just a great strategy. Well, we've been saying, oh boy, we're going to get another week out of this. We're going to get another month out of this. How long is this going to go? But it's been a very clear trigger to get out when it breaks that upper channel. So a week ago, we said, guys, this is starting to push above the moving averages. It's definitely a line in the sand when it gets over that. What was it? 2350 area, 2400. That's your signal to clear out of that bear call, clear out of those upper call credit spreads. That's a very bullish indicator if this breaks out and catches up to the other markets. So when you look at the market performance year to date, the S&P is pushing 25% here. The Russell was the leader the first 6 months of the year. Then it stalled and waited. The other markets passed it up. So I feel that the small caps are making catch up. They're trying to catch up to the other markets now, and they're almost up there. So this is a very strong breakout. And this is definitely small cap week last week, getting to the earnings season.
Yeah.
We still got a lot of small caps. The mega caps are over. So it's all about small caps. And looking at the earnings report, the mega caps, if they come in just as good on these small caps, Matt, it could push it higher. And what you and I noticed on Friday, all of us were sitting around talking about these sectors. It's broad-based. It's broad-based, and this is a very diversified group of stocks. So it's very broad-based, and we're going to see the earnings adding volatility to this. But as long as it's broad-based, I think this has room to run.
I certainly agree with that. But when you look at earnings, you mentioned earnings with the small and the mid caps there's a tremendous amount of energy influence on the Russell 2000. Would you guys agree with that?
Yeah.
Yes. Banks, energy, sure.
Banks,
Absolutely.
energy. Yeah. Out of all the different sectors out there, not one of them came close to the growth numbers that came out of the energy sector. Not one of them. When you're talking about 39% total against the S&P on blended growth, if you just take into account energy, it's like 70 to 75%. Like their
it
earnings
was
numbers
truly
were
an outstanding
fantastic.
earnings season for energy, without a doubt.
Yeah, and it wasn't in terms of when the numbers came out, it's not exactly like you had 5% blow off tops because you had a nice little run into that. But I do believe that the earnings backdrop for the Russell 2000 has been very positive, though. Those have been some extremely positive earnings results, and you're seeing the Russell 2000 break out. And when the Russell 2000 breaks out of long-term ranges, I think me, my dog Rosie was just in here, and everybody's expecting a leg up. It's just a matter of where does that slow down. Talked to Coach Frank on Friday about it. To us, 2,600 kind of stands out, but whether it's 25, 26, this is the beginning point of a new trend. And like I've always said, if you're looking at the Russell 2000 and the market itself is a little bit overextended in the short term, well, if on the Russell 2000, if this breakout is real, and I think all of us would agree this breakout is real, correct?
Yes.
Okay. Then most of the time, what transpires over time? More legs up. That's what happens. And so I do think we can be a little bit patient as we navigate the overextended ranges here. Let it consolidate a little bit. But again, when you're taking a look at the sectors, it's you see a trade, you take a trade environment, and that hasn't changed even with the overextended. I do feel from a technical perspective, though, if the S&P is going to show us that they're tapping on the brakes a little bit, and the S&P is showing you they're tapping on the brakes a little bit over the last 24 hours or so, then maybe we should as well from a directional perspective. Thoughts?
No, it comes down to rules, right, Matt? Like, and in an ideal world, and I know not every trader, especially if you're new, you don't have rules on, like, when this situation happened, this is what I do. A lot of traders, like when you've stretched, like RSI, which Gino is going to go over here in a few minutes, a great example. When the RSI is at this level, I scale back, or I do this strategy, or when A happens, I do B, C, and D, right? And so I think, listen, take a trade, see a trade, take a trade, especially if you don't have any like exposure maybe in that area of the market in your investing account. But there is nothing wrong with caution at this point as far as being super duper aggressive. This is not an environment where I would want to be like super over leveraged after a big run like this, for example. You know,
Well,
like,
and it's been a very good run, and I'm not saying that run is over. That is not what I'm
that's not what
suggesting
we're
at
saying.
all I'm suggesting is that over the weekend, I saw at least 1,000,001 articles about how the market is bull, 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 bull. I read them this morning about how this market's gangbusters. I read them how, oh my goodness, every industrial stock that's tied to infrastructure, up, 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 up. And I'm sorry, that's not what I'm seeing today. That's what I'm seeing over the last 3 weeks. That's not what I'm seeing today. What I'm seeing today is a little bit of buy the rumor, sell the news. And you could see a little bit of profit taking as a result. And so what I'm focused on here, guys, is I'm looking at these top end resistance levels in the S&P, and I'm saying, you know what, consolidate. Let's form up a pattern here. Let's go 2 more days of consolidation. Don't care. Tighten up that range. Give us an intraday signal. And so whereas let the media report whatever the medias want to report, but the media reports a lot of what has transpired, not what will transpire. Can we all agree with that?
Yes, absolutely.
Okay. So what we're actually reading today about and what we've read over the weekend about is everything that has been transpiring every day we break this down over the last 3 weeks, correct?
Yes.
So what's important right now from a technical perspective is not what media is saying about what transpired in the past. We know the momentum of the past. We know the market's at a 15 handle for us to tackle trading. We knew it was at a 20 handle last week. We knew it was at a 25 handle the week before that. We've been upgrading as this trend has been building its momentum. It's been a very consistent momentum, but we are seeing a little bit of chinks in that armor. We're seeing a little bit of slowing momentum from an intraday perspective. And again, whereas I've seen it all day long today, markets gangbuster, market up, energy stocks doing this, buy everything industrial, buy everything tied to infrastructure. And maybe, but we're also dealing with an environment where the last 3.5 weeks have not seen a high base, have not seen a flag, and you're dealing with a market that's extremely overextended in the short term. And so again, just want to reiterate,
Yeah,
the
I got a
chart
question
I'm
for you,
looking
Matt.
at here is just intraday here. Go ahead, Mark.
You know, because I also think like strategy selection, right? Like if I'm out there like chasing the market, buying a lot of calls, right? Not spreads, not stock, not selling naked puts, like just buying calls. You know, if the market consolidates, and let's say a lot of those are short dated runs, right?
Yeah.
You know, and I'm just pounding my whole account with it. I mean, you know, would you be more cautious if that is your go-to strategy in just buying calls where theta works against you in case we have a little slowdown?
Say that again, Chucky.
Like
It cut
just
out
on
real quick from
the buying of calls outright, right? You know, like, you know, you're chasing the market, you're buying calls. Like I know a lot of individuals buy calls. Like we could have like sideways movement for a couple weeks, and that could be a generally just bad strategy, even though the market does nothing. Like
I see where you're going with it. Would I have concern with buying call options outright with the market at the high, and if I personally expect 3 or 4 days of consolidation, if not a flag to come test the 9?
Yeah,
because that's kind of what I do expect.
That's what I'm taking from your words, and so would that impact strategy selection?
Simply because the S&P high basis doesn't mean there's not amazing trades out there. Remember, the market's not doing much today, and look what Cleveland Cliffs is doing. Right, doing a nice confirmation. The market's doing nothing today, and AMD's just blowing off at off on pause. I was going to say out of nowhere, but it's not. It's got some really good positive news. We'll cover that here in a second, and that's why I say yes. Even if I expect some of the momentum to slow down in the market from a technical perspective, doesn't mean there's not really good trades out there. There are amazing trades out there. So to answer the question, Mark, I have to look at the market from a volatility perspective, not just from a directional perspective, because again, I expect a little bit of consolidation here. Nothing dramatic. I wouldn't downgrade the market at all. I think the market's it's frothy. It wants to drive here. But again, you have hesitation in those movements. And so when I'm answering that question, I hesitate, but I'm going to do it anyways. you got to look at the VIX a little bit as an indicator of where the value of those options are. And with the VIX right now at about 15, it's right now at about 17 and a half. I don't think you have any concern with buying call options after the VIX just found support and it's now starting to work its way up, because if volatility does increase, as it should based on the technical parameters we're looking at in the VIX, then call options should go up in value based on the VIX, not down in value. And so I wouldn't have any hesitation with buying call options, especially think about it like this as well. We know what implied volatility does, right? Implied volatility is a measurement of individual volatility to that stock. Well, you take a look at what happens post earnings a lot of times. Here's the earnings report. Look what volatility does. It has a tendency to go down after earnings. Now, Tesla's a different beast. I just wanted to bring them up. But let's take a look at, say, Nike, for example. Here's earnings. What happens to volatility after earnings for the next 3 to 4 weeks? Volatility comes down. What starts to transpire is volatility starts going into the next earnings cycle. Volatility goes up. And so right now you're in an environment where, yeah, the market's at the top end of the range, right? We still have that underlying philosophical belief that you see a trade, you take the trade. But regarding volatility, you're coming out of earnings, which means a lot of that increasing volatility is now decreasing volatility. Volatility is certainly underneath the 50% level against implied volatility on many components in the market. And so with now 89% of companies in the S&P already reporting earnings, getting into their 2-3 weeks after earnings cycle, volatility is simply going to be at a low price. And now what should start to transpire over the next 3 to 4 weeks as we start building into that next earnings season 2 months from now is volatility should go up in that environment. So despite the fact the market is in an elevated range from a technical perspective, I still believe, again, that see the trade, you take the trade, you absolutely still can buy call options there because of the expectation the volatility should increase, not decrease.
Love it.
Does that answer?
Yep,
Absolutely.
100%.
Awesome. Let's take a look at some of the sectors out there. We've been talking about the market indexes. Gino, you do the Tackle Trading newsletter every single week. And Gino, you do such a wonderful job detailing everything that's happening in the market. And then one of the things we love doing in the newsletters, we love ranking our sectors, and we rank them from a scoreboard perspective, correct? We rank them from 0 to 0 on a football field, basically, right? 50 is right there at the neutral line. And so we rank all of our sectors based on that ranking system. And so far, so good in the marketplace. Market got an upgrade of 5 points to 15, Gino. But what I want to talk about is the sectors itself. We got 3 aggressive sectors: communication, discretionary, and technology there. Very quickly, Gino, I'm going to just lay out the rankings, and then I want to get your take on that. Technology here, let's look at XLK very quickly. Technology got a nice little upgrade to match the market, up 10 to the 15-point handle. Communication stayed pat, just cannot. No. And for those of you who were with me and Frank on Friday, me and Frank were talking about a potential upgrade in comps. When we got into the scouting report, guys, we just couldn't do it. We just couldn't do it. We just couldn't do it. Out of all the buying froth in the market right now, we were looking at all the stocks and comms, and it just wasn't there yet. It just wasn't there yet. And so we maintained that 45 handle in communications. And then when we looked at discretionary, obviously technology and discretionary are the 2 standout sectors over the course of the last 3 to 4 weeks. And so when we're looked at discretionary, is certainly overextended, but how do you deny an upgrade against a sector that just does nothing but go up and up and up? So got a 5-point upgrade despite the fact that it's overextended. I personally would not be shocked to see a little hesitation, maybe a little profit-taking sessions, maybe a little bit what Elon was hinting at in his Twitter Tesla, his tweet on Tesla, whether or not he should sell some shares. I think he was talking about every trader in the discretionary space. Should we sell some shares as well? A little bit of profit taking wouldn't be shocking to see in this space. But overall, this has been a growth area, a storyline Gino, what's your take on the aggressive sectors and what you're seeing in technology, communication, and discretionary?
Yeah, so Matt, basically in the growth sector, the sectors there, the two biggest mega caps lead the market right now, that being infotech and discretionary. Communication is just stuck into neutral. And by the way, we do have Disney report earnings, I believe, on Wednesday, right after the market. And that's part of that communication sector. I'm going to see if Disney gives that a little push either way, but it's just not keeping up with the market. It rallied quite a bit in the beginning of the year, and then just kind of not keeping up with it. Not sure the exact reason. So yeah, I do totally agree with the leaving it there in the neutral range. But as far as technology, you got Apple and Microsoft really leading. That is the biggest market cap companies. They finally joined the race, and I mean they're they're like almost 10% of the whole S&P. Those two stocks alone. In fact, I forgot what I put in there, but in the newsletter, the top two sectors, discretionary and tech, are your big mega cap market movers.
It is. It's your Facebook, Google's, Tesla's, Apple's, Microsoft's, all of them.
Out of the 11 sectors that we break the S&P down, those two alone are over 40% of the S&P 500.
That's so big. It's such a big number.
I mean, does that even seem fair? And that's why when you look at our gridiron, the S&P is lined up with XLK and XLY because they are the majority of the market. They are they're like your top running back and quarterback, right? I mean, they are the team right there. They are the ones pulling the market up. They're the ones keeping it up. Communications isn't helping, but if communications did help, the market would be a lot higher. It really would. There's some big names in communications. When you look at discretionary, and I think we talked about this last week and the week before and the week before, Amazon wasn't really helping discretionary. And it's finally starting to get into the game. If you look at Amazon here, it's finally starting to break out. It's starting maybe it's not really your top stock in there, even though it is like 23% of discretionary move. So with that said, I mean, without Amazon, a big name helping discretionary, there's a lot of strength in there. A lot of strength. I don't know what we're going to do with communications. There's too many other stocks to pick from right now in the growth sector. So I'm sticking with, there's plenty of trades in discretionary tech alone. You could, in fact, I'm going to be using those as my RSI, how to sort out and go through the ones you need and throw out the ones you don't need. So,
well, can I mention something on comms? You've had a lot of strength in discretionary and technology. Those two sectors have been so impressive over the last month. It's so impressive. I cannot say more positive things about what has transpired in those two sectors. I can talk a lot about it. You may have left some traders at the train station with a little bit of those parabolic movements, but overall it's been a very impressive type price movement in those two areas of the market. Typically speaking, communications follows in line with those two sectors. It doesn't do the same thing because, again, communications out of every sector is a little bit of, that two-face type scenario where you have some growth and you have some value there. You have growth, you have dividend there. Technology is all growth, right? Discretionary is all growth. And so comms will beat to its own drum. But doesn't comms have its day at some point coming into the near future? This is an entire marketplace that has just went gangbusters over the last 4 weeks, and yet comms hasn't done that. Comms has really maintained its support. It's maintained its resistance. So even though comms is out of favor right now with everybody, guys, us included, right? It's out of favor with everybody, or we would see better price movement here in this type of market. Is comms something you're looking at though for potential if we do see some degree of breakout here? Because technically speaking, if you were just to give me blind charts, right? Just blind charts, remove the names, remove prices, remove all moving averages, and just give me a blind chart. and you asked me which one would I buy on that blind chart, would you blindly buy a parabolic movement at the top end of the channel on technology? Would you do the same thing on discretionary, or would you buy the breakout against the neutrality range on comms? I'm going to tell you it would take me about 2 seconds to say comms.
No, like this is 100 out of 100 decision, right? Like for me,
So,
it's
and I guess that's just what I wanted to bring up and wanted to talk about is comms out of favor, guys, but things can quickly get in favor, right?
No, and I think that goes to Matt, like yes, overextended some things, but like if you get clean signals on new things, right?
Yeah.
If you get clean signals on new things, there's see the trade, you take the trade, knowing that those clean signals can produce some nice results, right? Like if the S&P ends up at 4,900 at the end of the year, I have a pretty good feeling you're going to get some broad participation, right? Like it would be hard to say, yep, I'm going to end up at S&P 4,900 at the end of the year, but only these couple sectors led the way. You're probably going to have some broad participation. And we've seen that a few times this year where things took turns, right? One would have a little stretch, then it would be followed by another. So if you see clean signals in different sectors, I think you have to pay attention to those.
Yeah, and it's, I don't want to say it's the same thing, Mark, but, when you're looking at energy here, energy neutral, doing absolutely nothing, nobody's even talking about it. And then all of a sudden it broke out, everybody woke up to it, a nice little trending environment. I look at the communications, again, not calling my shot here. I'm just saying, put it on the radar because you got some neutrality, the 200 days catching up to it. And it looks like a little bit of consolidation, and you could see a nice little breakout there. I just say, let's not all just leave communications to its death, because I kind of feel like if Disney posts a positive number this week, could wake up the sector a little bit. And so whereas a lot of what has been transpiring in the market is based on discretionary, is based on technology, guys, we know what happens in the market a lot of times. Areas that have been so good, sometimes they have a tendency to slow down a little bit, and that will wake up other areas of the market that have not been participating. And it's a little bit of a mini philosophy, and you two know this philosophy very well, the dogs of the Dow, right? Have you guys heard of that? Right? Yeah. The dogs of the Dow. Gino, when people say the dogs of the Dow, what typically are they referencing there?
When dogs of the Dow is when you take your big name, usually Dow companies, but you can apply it to the OEX or a major sector like this or a mega cap. Which ones are out underperforming? And this is a great example, like you say that, Matt, because when you look at the comms, you're looking at that sector is basically about 40 to 50% Facebook and Alphabet. It really is. And those are growth companies, right? Those are big, volatile growth companies. And then you got Netflix in there. That's the number 4 player in there. You got Facebook, Google A, Google C. Then you got Netflix. Netflix is only 5%, but it's still a growth company. It's still a growth company. Now, when you start getting down the list in that sector of the stocks, number 9 and 10 are your dogs of the dogs of the Dow, Verizon and AT&T.
Yeah.
Now, when I said that, I know Mark's thinking, oh, I'm AT&T, Verizon, man. These are our dividend players. These are big, solid companies that are totally underperforming, right? And the dip, and now that they've dropped down, their dividend has gone up because it's an inverse relation. Stock price goes lower, yield goes higher as long as they maintain that dividend. And I'm not sure what the current dividend is on these stocks, but they're quite attractive.
How much is AT&T bribing us to buy them at the low price right now? It's
not enough for me.
It's 8.29. It's like 8.3% right now.
That's better than a bond, right?
Last I checked, it's better than any bond since 1992.
Right. And
there's a good chance it's better than any bond until we are.
I pulled my date for a reason. I said 92
before
for
we
a
are
reason.
you will be sitting at my funeral one day, Matt, and be like, Mark's right.
Once owned a bond for 3%.
at your funeral.
Yeah.
Yeah.
I
Hey,
promise you, when I'm speaking at your funeral, I will not mention the bond market.
Who in the world buys bonds?
at your funeral, Matt's gonna be glad he can finally beat you in the fantasy football. Okay.
That
So
may not happen between now and then. Let's stay positive here on
back to the
the
dogs of
Monday
the
here.
Dow. Let's get off Mark's funeral and talk about dogs of the Dow.
But again, oh, go ahead, Gino.
You look for companies that are still value. They still have values. They're going to stay in business. They got a good dividend. They got some kind of fundamental. They're a big name. They just were taking a back seat to the growth. They're taking a back seat to the trend. And usually time has shown if you invest in those companies who've not kept up with the market or pulled back or been out of favor, you bottom fish them. And they're the ones that come back the next year. Now, the theories behind that are because, listen, there's money shifting into growth and
rotation.
Sector rotation, growth to value rotation. And also think about this. I also heard from when I was learning back in the day about stocks and how they work. If you're underperforming and your stock price is dropping, the boardroom's saying, hey guys, what are we going to do to get our stock price back up? We need to do something. We need to do repurchase our shares. We need to bring up our sales. We need to restructure. We need to budget, whatever, to get us to stay in this index, to keep us in this sector, to keep us at a better status, because we don't want to be kicked out of that Dow. We don't want to be kicked out of the S&P 100. So they're going to do something. So it kind of is like, yeah, this team's going to be pushed to do a much better next year. That's the theory. And just speaking of that,
and it's something to keep an eye on, right? It's something to keep an eye on as we do navigate a little bit of an overextended situation in the discretionary as well as the technology space, and as the only growth component to not participate in any of this earnings hit parade that we've been seeing. And a lot of that is not because this sector's been missing on earnings, but a lot of it overriding news, like the Facebook news and the controversy surrounding that, and obviously the impact that Apple's new privacy policy has had on companies like Snapchat and Twitter and Facebook. A lot of that has been priced in through fairly aggressive drops in price action following earnings. It's going to be interesting to see this sector. And again, we're talking quite a bit about a sector today that isn't performing. But again, it's something that I'm looking at here saying, you know what, I like the neutrality. I like the potential breakout. I just don't like a lot of the stocks in the sector yet. But if you give another 3-4 days of consolidation where you kiss up against this breakout channel right there at about the 8220 barrier, maybe put it at 8250, as you start to navigate that 50-day moving average, watch that 90 MA catch up to it. And again, I've seen this many, many, many times, guys. Energy was just the latest before it had a massive run. But right shoulder breakouts after reversals have been strong in this marketplace. Comms is looking at one down the barrel. Can it be that next greatest right shoulder breakout? Stay with us as we navigate that. Let's talk a little bit about the cyclical areas. And Gino, very quickly, it's I don't want to say it's rare to rank everything very similar.
This
right?
was weird,
But we have this weird scenario happening in the cyclical areas of the market, and once again, that's energy, basic materials, finance, and industrial, the ones that are economically sensitive to the marketplace, where you have all of them ranked at 25, but yet that's where we stand here today, all of them ranked at 25. But for a little bit of slightly different reasons. Some are increasing its momentum, some are decreasing a little bit of momentum. And so when you're looking at a downgrade in finance, you're looking at a couple downgrades over the last couple weeks in energy, whereas you're starting to solidify yourself in basic materials and industrial. Let's first talk about the downgrades that we've seen in finance specifically, and the downgrade we saw last week, a little bit of maintenance mode with energy this week, but downgrade in finance. Gino, can you talk about the downgrade in finance?
Yeah, so financials were the leader coming into and through earnings season because they started the earnings season with
in the cyclical in cyclical areas.
In cyclical, So you had the big Goldman Sachs, You had some of the banks coming out, and that was our first kickoff season. Like, okay, there's some big names here. How are we going to do with earnings? And financials did real well,
Mm-hmm.
and then they rallied. I mean, and it was enough after, like, I think about a third of the banks came out. We all said, hey, we see a trend here. This sector is good. We upgraded it. And it got up there to the 15-yard line, 10-yard line. We were like, God, this thing's on fire for financials. But there was a lot of unknown in the way. There was a lot of, we got the FOMC meeting coming up, which was last week. That was still in the way. We still have a lot more earnings. We have some growth companies that are not big cap names. They might say something. There's a lot in the way, So we're like, financials could be sensitive with the FOMC outlook, the bond tapering purchase program, all that stuff. And it was the leader there, but it broke away from the cyclical group. And what was interesting was it was, way up there on the 15-yard line when industrials and materials were all down there in the neutral area. And we know there's going to be sector rotation. So this is common. Right now, it is still bullish. I mean, financials is still bullish.
Oh yeah, absolutely. It's just a little bit of a momentum decrease, which means we're going to slow down with the market. As the market slows down a little bit, we're going to slow down with it as well. And so you're seeing a little bit of a technical decrease in a little bit of technical slowing momentum, which was really what the downgrade was based upon. We saw something very similar in the energy space.
Same with energy.
And the exact same when you're talking about crude oil. You've obviously seen a little bit of shifting character. The market's looking a little bit more neutrality short term, not a wide range here, 80 to 85, but looks like a little bit of range bound until we can see a legitimate breakout one way or the other. When you're looking at the energy space, a lot of the energy movement has been based on the anticipation for earnings. We're post earnings now. Energy had a standout earnings season, guys. There's not a sector that had a better earnings than the energy space. Mark, report after report after report, I saw that argument play out in the numbers, and the argument I want to remind people of is the argument we've been making for a long time, that fundamentally these are undervalued. Their numbers are going to be rock stars, and as long as crude oil continues to appreciate, the average price of oil is going to continually appreciate, which means those earnings numbers are going to go up as well. That argument played out. It rang true. It was true. Best sector from an earnings perspective was the energy. But over the last 3 weeks, it's taken a little bit of a breather here. It's consolidated. You're within the range, but it is outperforming crude oil in that same time frame. Very similar price movements, but think about crude oil for a second. Tested a breakout channel, tested underneath 80. Energy didn't do that. Energy held the breakdown channel, and now we're fighting up against another breakout. What's your read on energy, Mark? And you were talking earlier today about maybe a little bit of thirst for that delta, for that directional movement with the breakout here of 59.5. Would you see this as a directional type movement? And because for me, if I see a breakout, I'm upgrading the energy space. We've had great consolidation. It's been fairly consistent consolidation. It's been over a 2 to 3 week time frame. Moving averages has caught up to it. You're now in front of perhaps a breakout. Is this something you're looking at from a directional perspective?
Yeah, no, I got lots of thoughts on energy, and I'll try to make them concise. I think you have a positive fundamental backdrop. I think that, I saw a lot of articles this weekend re-highlighting the Shiller Cape ratio, basically pointing out that, hey, we're approaching .com levels. That doesn't mean every stock or every area in the market isn't not only overvalued, but offers some really interesting true value propositions. I think energy is cheap here from a valuation standpoint. I love the backdrop. I love what OPEC did. Hashtag as expected last week, not succumbing to pressure. I think there's just a real positive backdrop. And, on a directional move, I have existing bull call spreads, cash flowing existing positions. And then I have some longer dated bull call spreads that I have in place, kind of almost front running a breakout here. And if it doesn't break out, no big deal, whatever. Most of my holdings are cash flowing. But if we get positive signals, I'll add exposure. I'm not so heavy that I can't add exposure to energy. And I think there is a real positive backdrop. I mean, everyone's talking about higher gases. Everyone's talking about higher oil prices, right? It's not like this isn't in the investor and traders conscious.
Yeah.
You see movement in that. I think you have, traders chase it, adding to the momentum, adding to what is a pretty good investing backdrop right now. Best one you've had in a long time on oil. Holy cow.
Well, and Mark, you talked about the Shiller PE ratio, the CAPE ratio, the cyclically adjusted PE ratio. Robert Shiller, prize-winning economist for the CAPE ratio. A lot of traders prefer the CAPE ratio over the standard regular PE ratio from a market index perspective because it is more accurate. And I will say it is more accurate. When you're looking at the energy space, though, it is the second lowest value from a Shiller PE ratio, right there at 25. The only thing lower than that is the financial sector at 21. You're talking, but you are talking about a backdrop that is approaching, from a valuation perspective, the .com market. That is an accurate assessment, but that accurate assessment takes into account a discretionary space with a Shiller PE ratio of 66, Mark. That takes into account a Shiller ratio on the real estate space at 57, on comms at 53, basic materials at 38, technology at 52, energy 25. So I would say from a historical perspective, you are still range up from a value perspective, especially after 12 years of price appreciation in the most dovish Fed environment in the history of mankind. But if you look at the energy space relative to the entire marketplace, I'd say you're still, even after the run you've had this year, being one of the best sectors this year, you're still undervalued in relative terms to the rest of the broad market. And when you look at the cyclical areas of the market itself, energy and finance are the two lowest lowest from a Shiller PE ratio in comparison to the industrials at 32, in comparison to basic materials at 38. And so, yeah, even with the technical and the improving technical condition in the energy space, remember, those earnings reports out of the energy space were amazing this quarter, were amazing, which means the actual valuation contracted despite price going up. That is a positive fundamental development, not a negative, in my opinion.
I mean, Matt,
Thank you for bringing that up.
I can't get on, because I've read a lot of energy reports, and one of the big things that have hung over the energy sector for so long is just the massive debt so many of these companies have piled up. Man, they are just paying off huge chunks of that debt every quarter. So not only do you have a downtrend in debt, that thing, I mean, just massive chunks of debt really taking one of these weights that have hung over the energy sector for years and years, piling debt, worries, how could they ever get ahead? Well, they're starting to pay off a lot of that debt, creating an even better fundamental backdrop and confidence from an investing standpoint.
Nice. Awesome. Thank you for your thoughts on the cyclical areas of the marketplace. Let's take a quick peek at industrials to kind of bring industrials and basic materials into the same conversation. We talked on Friday with Coach Frank about the breakout potential in industrials. He's seeing a little hesitation, a little snapback retest of that breakout channel. The weekly chart looks fairly strong, if not a little elevated coming into the breakout. Wouldn't be shocked to see a little consolidation at that breakout. What's your read, Coach Gino, on the breakout potential in the industrial space? Because not exactly similar to the Russell 2000, but we have had a nice prolonged neutral condition in the industrial space, breaking out of that here late last week, continuing a little bit today, although weak. What's your thoughts, Gino?
Yeah, so like we were talking about this whole cyclical group as we downgraded financials a little bit and energy topping out. I see that more as sector rotation within that group of cyclicals. I see money moving into industrials and materials, both of those. And yes, they're all lined up, the same trend, same strength. It's kind of like portfolio balancing. Let's take a little bit of money out of financials and put it in industrials. I see that being fueled up, and I really like industrials for the fact that It's very balanced sector. It's not overly into one stock. That's great. It's one of my favorite sectors going into this week. There's some great setups in there. And that's why we upgraded it, Matt, is because we saw some good setups in industrials. We saw some big names in there. And I like where it's at now. Can it continue? Well, if this is the year-end rally, this is probably, cyclicals. Definitely growth is the focus because that's the big movers. But there's a lot of big names in here in industrials and a lot of good setups. So I'm focused on this one actually more than financials.
I am as well in the short term, Gino. I like what's happening in industrials. I think it's time to refresh a little bit of those watch lists in industrials. They've gotten a little dust on them over the last 5 to 6 months here, Gino. But the market's waking up, and again, I say this all the time. If the market wakes up to something, it's about time we wake up to something as well. We like to be in front a little bit, but sometimes you wait and you wait and you wait, and you see the breakout. We're seeing it here on industrials. Materials hasn't been breaking out. It's been a nice little trend over the course of the last month and a half or 2 months. Looking at a very similar breakout to industrials, a little bit range up here, Gino. We'll take a look at materials as it navigates this breakout throughout the week. When you're talking about the defensive areas of the market, those are utilities, healthcare, real estate, and staples. A lot of maintenance mode last week for us at Tackle Trading, Gino. We maintained the rankings in utilities. We maintained the rankings in healthcare. We maintained the rankings in real estate. And just quickly speaking, when you're looking at these trends, you're looking at a little bit of downward movement in utilities. That would now get a downgrade based on the price movement, but that obviously was not there on Friday. When you're looking at the real estate space very quickly, XLRE, a little bit of high base as we navigate that breakout channel. Keep an eye on that breakout channel at right there north of 48.75 there. Tick wiki to wick nonsense, a little bit of 48.85, but overall high base scenario. Going to see a little bit of slowing momentum here, in my opinion, as we navigate that all-time breakout in real estate. And then when you're looking at healthcare, Gino, and this is the question I have for you, Gino, on the healthcare. Healthcare has been solidifying itself ever since, and I said this literally live on the halftime report right when Johnson & Johnson reported, Gino. I said it then, I'll say it now. This is not a good report, but the market is pricing something in here. It is showing the buyer's thirst. We've seen that buyer's thirst play out really strong ever since then. Gino, we maintained healthcare ranking despite a little bit of an aggressive drop in price on Friday. And the argument that was made was basically this: we haven't violated anything. We haven't violated a trend. We haven't violated a pattern. We haven't even violated a short-term support or resistance level. You're just looking at this as a little bit of a snapback at this point, maybe a flag-based pattern. Gino, maintenance mode here in the defensive areas. On this pullback here, is this something you're looking to add to positions? Are you looking to take advantage of a little bit of the pullback? What's your read in healthcare?
So healthcare, as far as the defensive group, is one of my favorites. It's one of the big market caps of the market too. But yeah, there's some big names in there. And of course I have to look at those anytime I screen for a portfolio position. But yeah, this is a pullback to a possible swing low. Looking at the past earning day performances, most of the stocks had a positive move after their report. Whether the report was good or bad, they had a positive response in price action, most of them. But it's not trending nearly as strong as the other sectors. And that's because it's in the defensive. And when risk is on and we're in growth and technology and we're shifting money over there, and you see the cyclicals balancing, you don't see a lot of money going into defensive, but there are some growth picks in healthcare. So Matt, to answer your question, it's kind of yes and no. There's some great growth plays in there on stocks that are moving and hitting new highs. That's the ones I'm watching. The ones that are pulling back right now and underperforming the market, I might add to them for a investment portfolio, but not for a trading portfolio. I think this will hold. I'm looking at this as a pullback in the group here. I think this will hold if the market continues to stay bullish and if the market stalls, because it is the defensive sector. It's your hybrid.
It is your hybrid. There's no doubt about that, Gino. I mean, if there's two things I'm looking at in the defensive areas, well, sector-wise, utilities is just kind of gross right now, so it's kind of just a stay away, right? Just stay away. But when you're looking at healthcare and when you're looking at consumer staples, you got to be looking at these two areas of the market as waking up after recent bouts of volatility. Both of them pulling back a little bit here today. Consumer staples a little bit more aggressive than healthcare, but I do think you're looking at the support levels a little bit this week that you haven't been in recent history as we've been navigating more breakouts. And so now I do think it's a time where, for 3 straight weeks, Gino, I was analyzing breakout potential, right? Because that's what the market was doing. Mm-hmm. But I just kind of have a feeling like we're a little bit range up in the market, whereas everybody's in celebratory mode. I kind of feel like the market's going to do a little bit of profit taking here. And so I do think we're going to be navigating some support levels over the course of the next week or so as we test some of these ranges, as we test a little bit of the belief system in the marketplace, which is normal. I'm not like, it's routine. It happens all the time. And so when you're looking at this space right here in staples, I'm looking at 72. I'm looking at that 9 EMA that obviously staples has been riding as you're getting into a very, very clean breakout channel at 73. And so, yeah, you're a little bit range up going into that breakout. I'll tell you right now, it's overextended going into that breakout, especially for staples. We're talking about Coca-Cola here. We're talking about Pfizer. We're talking about Pepsi and these products that are just mainstays like Colgate, like toothpaste, right? Right. And so it's just running a little bit hot as we're going into an all-time breakout. So wouldn't it be shocking to see a little bit of a pullback, test those support levels? It wouldn't be surprising in any capacity to see a little consolidation here. And so in healthcare, I see this as a flag-based pattern that's coming into a weekly support level that's going to take a little bit of time to navigate. And when I look at consumer staples, I'm obviously looking at a sector that has woken up, but you are range up in staples as you navigate a major breakout. It looks to me like it wants to pull back a little bit and then make another run. But overall, so far, so good. Lots of upgrades over the last couple weeks, just a little bit overextended in the broad market. Gino, I want to get your take on a couple quick things. First and foremost, gold. Gold's last 2 days have been extremely impressive against a backdrop of very, very inconsistent price action, Gino. And that's what has been driving me absolutely crazy in the gold market, is the inconsistency of the intraday analysis. But one thing I'm seeing over the course of the last few days is you're seeing a little bit more consistency in these upward movements in price, and the intraday support levels are holding, whereas in recent history, they certainly have not done that. Gino, gold got a little bit of that upgrade that communications did not get. 40 handle, Gino. Yeah. 40 handle usually means we're looking at a breakout here. We are testing that 1830 level, but once again, I'm not removing my line until that line is removed for a reason here. You're looking at rock solid resistance between 1835, 1840, Gino. We are coming into that level with some heat here, Gino. Are you looking to add to gold positions with a breakout? Or is this still something you're waiting? You're wanting to see a little bit more information on?
You said it to the T, man. That 1840 level, 1850 magic number there. Mm-hmm. I want to see that tie in with a little bit of dollar weakness, though, when it triggers.
I like that.
I want to see something fuel this. I want to see not only the dollar weakness, but I want to see Bitcoin weakness when this breaks. I want to see money come out of Bitcoin and into gold. and honestly,
I'm not sure many people want to see money come out of Bitcoin right now.
Well, I think that there's actually the millennials, I've talked to quite a few of them, Bitcoin traders, and they're like, why would you be in gold when Bitcoin moves so much better? It's the gold of the future. And I'm like, oh my.
Well, gold's been the currency of the last 6,000 years. So, I mean, we'll get Bitcoin to stay in the sun. There's no doubt about that.
Seashells were the currency.
The amount of people historically who have called for the end of gold that have been proven wrong historically is in the millions upon millions upon
Yeah.
millions upon, if not billions. And
Yeah,
so
I'm still more confident.
I'm not there yet.
I got you. I'm still more confident in gold. I still use stop losses in my Bitcoin. I use protective puts anytime I'm trading any of those Bitcoin type companies.
Now,
But when I
Gina,
do gold,
what you just said is like I understood everything you just said. Like it told me everything you see Bitcoin as an aggressive growth situation where you
yes,
treat it
big
very
time.
technically, right?
Yeah.
Whereas gold, you see it as an investment where you're not wanting to get out for any reason until
Exactly. I mean,
right.
I got gold and silver on that paper equity
Yeah.
and the physical.
Well, when
And
when a trader tells me they use a stop loss versus using put options, it tells me everything about how you approach that instrument. Yeah.
Exactly. And when we talk about silver and gold on the paper or the ETF equity or the futures, you cash flow it and you hold it for an investment. It is your what you call, like we were just talking about, your defensive sector. It is part of your defensive sector against the currency, global economics. And that's where experience and time in the business, time in economics, and talking to people that have been around investing all together, not just in the market, but everything. So gold, I'll tell you, man, it's been tricky. It's been tricky, especially for all the gold players.
Well, I want to stay with what you said originally, Gino, because I'm looking at gold here and I'm saying, yeah, the last 3 days has gotten back to more consistent bullish price action.
Yeah.
Whereas even in this upward drift you've had in gold over the last month, it has not been consistent on an intraday perspective.
Oh,
It's at 1 to 2 days where it's been a no all sell or all buy day. Outside of that, it is wickety wick. It's random. It's inconsistent. And so I said this in Discord over the weekend, but I'll say it here. The last couple of days has built into that consistency, and I do think gold has an opportunity to break out. But I love what you said earlier, Gino. You said, yeah, I like what I'm seeing in gold, but I'm also looking at the dollar saying, listen, I'll have a lot more confidence in gold if the dollar starts showing some weakness as well.
Right.
And while in the last three trading days, gold has become more consistent, I don't have that opinion on the dollar. The dollar's volatile and very inconsistent right now.
That's true.
So I'm with you, Gino, but I also think that the gold needs some time to navigate 1835 to 1840. And in that time frame, we could see a little fade down and a break of 25. So I'm looking at that same thing as well, Gino. I'm looking at the dollar chart on UUP saying, okay, range bound's fine, but you got to show us a little bit of downward drift here. It maybe a break at 25.2 would suffice here, but you got to see a little bit of a downward movement in price in the dollar because these two things are divergent against one another. And right now they've kind of separated.
And I don't want to get too deep into this right now, but this is a good topic. Is after the FOMC meeting, I saw a turnaround in gold, and ever since then it's been rallying up. Do you think that had anything to do with it on the gold outlook based on the FOMC tapering? Because it's turned around since the end of that meeting. I mean, it did a U-turn.
Well, it did, and the simple reality is the overall reading of the Fed over last week, I think, is dovish, right? They even in announcing tapering, they still left it a little open-ended to allow them to change the pacing of the tapering, which was, at least in my opinion, was interpreted as, oh, so you're saying you might not taper in the future if there's any economic reason not to taper. Because they're not going to speed up the tapering conversation. They're staring at inflation of 5% right now, and they're still saying transitory, Gino. So and that's been going on for over a year now. So, and they've been wrong in every single time frame of that. They're still sticking to the transitory language, even if they're not using the transitory name, right? They're still talking about the same talking points that led to the word transitory in the first place, all of the inflationary tied to supply chain issues and not tied to an expansion of monetary policy or an expansion of fiscal policy, which I just feel is not intellectually honest, in my opinion, and they know it, but they don't want to admit it. But I don't need to put the tinfoil hat on today. So in terms of this, I do read the Fed as dovish, which typically does have a downward drift on the dollar and an upward drift on gold there. And so as we've seen that play out, because again, all the headlines last week were what? Fed's tapering,
Yep.
right? Fed's tapering, right? But then when you actually get into the interpretation of the Fed, they left so many ways they could come off that. And even in their tapering conversation, when you look at interest rate policy, the market currently expects 2, maybe 3 interest rate hikes next year. After what Jay Powell said in his press conference last week, I'm not sure we're going to get 1 interest rate hike next year. And so I personally took what the Fed did as dovish, even if the initial headline result was interpreted as hawkish. We're reducing our stimulus to the market. When you look at when you interpret the Fed like I do, and you read literally everything the Fed ever puts out there, you can see what they're trying to do, and what they're trying to do is leave themselves out. So they're trying to leave themselves room to interpret where to take monetary policy in the future. And if you use Europe as an example, if you use Australia as an example, if you use Japan as an example, if you use any central bank from around the world in the last 2 weeks as an example, you will see very quickly how aggressive they come off interest rate hikes if there's anything negative in the economic data. And so I certainly took their interpretation last week as dovish in terms of their actions they took. That does typically lead to decreasing dollar and increasing gold. And so can that play out that way from a technical perspective? You're starting to see it, Gino. You're starting to see it. That's a little bit of the consistency you've been seeing in the gold chart over the last 48 to 72 hours. But I have not seen it yet out of the dollar chart. I got this still as volatile and crazy without a clear direction. And so I'll tell you, when you made that statement, it was just one of those moments. I'm like, yeah, you're right. Absolutely. I've been looking at the gold chart way too much here. I need to also look at the dollar chart because these things are coupled together.
Yeah, the dollar chart and the outlook, when you get more of a firm and confident outlook from the Feds, then you get more firm and confident investment choice on gold, and yeah. I just see those going hand in hand, because I was like, wow, gold market closes right before the FOMC announcement. So I was watching the after hours action of it, and I wanted to see if it follows through on Thursday and Friday. And it bottomed. It bottomed, got the meeting notes, and boom, it rallied. And it hasn't looked back. So if I see this follow through and break through those trigger points, I'm going to say, yeah, a lot of decisions were based off of the Fed's decision there on gold. Now, why they would go to gold and not play the growth sectors and end of the year rally, I don't know, but it's an investment choice, right? Mm-hmm. So I'm with you.
And last but certainly not least here, Gino, let's talk a little bit about Bitcoin. Gino, Friday, Coach Frank and I were breaking Bitcoin down technically on multiple different time frames. And basically, I went through 3 different scenarios where you could have had a triggering impact in Bitcoin over the last 2 weeks. And basically what I said on Friday, because I want to do a detailed technical breakdown, because over the last 4 days, I keep getting asked the question, well, what about Bitcoin? What about Bitcoin? What about Bitcoin? Simply because it hasn't went up, right? And so I wanted to have a conversation openly with our community saying, guys, I get it. It's not going straight up. That's fine, though. But has it violated anything? Has it violated anything about the reason why you wanted to participate in the first place? And whether you were buying this flag with the stop loss underneath 60, or whether you were buying that with the stop underneath 58, or this continuation underneath 60, the point was the trade is still working out. Remember, the market's going to work. The market's going to move on its time frame and not on your time frame. And so we did that thorough discussion on Friday. We're seeing it pound the table here today, Gino. We're seeing a breakout on multiple different time frames. And again, Bitcoin is, we're looking at the futures. Bitcoin is a 24-hour tradable instrument, including the weekends. You're seeing it hold at 61 and then just drive up in price. Obviously, resistance is forming at 67,000. That coincides with some chop over here, all-time high type chop at 67,000 as well. Gino, what is your take on Bitcoin? Is this an add to, or is this just a celebration against the retracement?
You know what this is? This is sell your 10% stake in Tesla and put it in Bitcoin.
Is that what this is? Is that what Elon's
Yeah,
doing?
well, that's what I'm wondering. What is Elon going to do with his money if he sells it, right? What's he going to put it in? Is he going to put it in Doji finally? I don't know, but here's the thing. That is a very bullish, Matt, if this was a stock, you'd have to put a trigger there, right? I mean, if you're looking at this, you're thinking, okay, this could be a very good breakout here.
Yeah, it's a breakout on multiple time frames. The intraday is confirming, the daily is confirmed, and the weekly is kissing against the resistance channel. It looks like it's a little bit of a party time in Bitcoin here today. But again, navigating 67,000, Gino. So keep an eye on that 67,000 handle. Once again, question, I want an answer. Is this an add to, or is this a I already added back here and I'm just celebrating?
Oh, if the breakout's an add to.
Gotcha. I just wanted to get your take on it.
The breakout's an add to. Yeah, you have to. I know it sounds crazy, but I don't even want to go to the Reddit boards and all this stuff on this. It's craziness out there what they're talking about. Oh, this is going to 100,000. Okay, they're just so much emotion behind this. It's craziness out there. Please use a stop loss.
Yeah, it's Bitcoin. Use a stop loss. But at the end of the day, Gino, you got to always ride. You always got to go with where the market wants to go.
Got to go with strength.
And you got to go with strength here. And Bitcoin is strength, and it's breaking out on multiple time frames. Can it get to that almighty 100,000 number in one run?
In the news.
I don't know. Like eventually, yes, and eventually could be 3 weeks from now. But let's see the breakout first, right? Let's see the breakout first. It's kind of like I always tell the banks, hey guys, before oil gets to 110, it's got to get to 90. So I get, we want everybody and their dog wants to go out there and publish their newsletter and get a lot of clicks on their newsletters. And you know, when you say Bitcoin's going to go to 100,000, it attracts a lot of people. But I like real analysis, not fake news type stuff. So let's break out first. But gotta love the price action going into that breakout. Gino, I only got a few stocks to discuss here. Want to get your quick take on Tesla here. Gino, you made the joke. I'm gonna have you break it down here. Okay, Tesla. Elon puts out a tweet asking his followers if he should sell stock. Close to 60% say yes, Gino. Now, I'm just going to say
what
this.
Was the reason? What was the reason?
The reason is this. Elon was feeling a little bad over the weekend, and he just wanted to feel the love from his community. That's the reason. Because if you're Elon Musk, you have to file with the SEC to sell your shares of stock. He had done that a month ago. This is just nonsensical Twitter stuff. But, Gino, what's your take on him taking a little bit of profit? And by the way, guys, Elon sells stock routinely all the time.
Right.
Literally all the time.
Right.
That's just Twitter nonsense. Has nothing to do with anything. Especially when we're talking $1 billion against a $1.5 trillion company. It's a non-story. But it gets a lot of headlines, Gino. So I'm going to ask you a question. With the recent, a little bit of slowing momentum in the discretionary space, just a tiny bit. And a lot of that is due to Tesla coming down today. So they kind of go hand in hand with one another, right?
Yeah.
But if you were in Tesla, and I'm not going to put you on the spot because but let's say you're hypothetically in Tesla here, and you've been running this freight train post earnings, and you've been just swimming in gold coins like McDuck off what was that one television show, the DuckTales or whatever? Scrooge McDuck, right? You're swimming in gold. Are you taking a lid off the table here, Gino, or are you still letting it ride?
Well, that's the thing is, first thing to my mind is, what is his goal here? I mean,
his goal is to get more Twitter followers. It has nothing to do with the stock price.
I mean, it's manipulating. The stock had a new high. It was up hitting highs there over 1,200, and look at
and honestly, Gino, it drives me crazy about it. I like so much about Elon Musk. Right. I hate this side of him. It drives me absolutely crazy.
That's the thing. If I have multiple accounts, I go short a stock in one account and a long a stock in another. Guess what? I get an email from my broker saying you're manipulating the market. You can't do that. But this guy comes out and tweets, I might dump 10%. The stock gaps down, causes millions of dollars of swings in portfolios. And That's not manipulating the market, right? I mean,
Of course it is. Of course it is.
I mean, this guy's moving his stock, of course. When you do that, when you're an insider, but throwing a tweet.
Maybe the SEC will fine him another 20 million to get him to stop talking about his stock on Twitter. I don't
Just
know.
out of curiosity, how many times has Warren Buffett done that with Berkshire?
He doesn't have to because he's Warren Buffett.
He doesn't come out and say, hey guys, what do you think I should do with my stock investment?
Although he did say, what should I do with my 150 billion in cash flow right now? we're all kind of waiting on Buffett for that one.
Yeah.
But no, I get it. But again,
yeah, well, that's the thing is it was just stirring the pots really. And also, that kind of tells me, why is he asking the public, like, trying to win followers? And hasn't he already talked to this with his financial advisor and the guy running his broker?
He has to file with the SEC and the governing bodies to sell his stock. These aren't, it's a publicity stunt. That's all it is. And again, it's a sideshow. It's the circus that comes to town, and it takes away from what Tesla is actually trying to accomplish.
I mean, I was talking to a fellow trader of mine who is a big option trader, major option trader last week. They said, did you notice the volatility in Tesla's options? You can literally sell puts 3 weeks out at the 350 level. Now that's like 70% out of the money. Okay. Anytime there's a premium 70% out of the money on puts, they know something. There's something out there. There's no reason. We're past earnings. There's no reason for there to be volatility in the puts. So what I'm wondering is there more manipulation than we think of going on here when you start getting put premiums down there? I mean,
a lot of that is because of volatility has increased even post earnings with Tesla, because volatility is just a measurement of
very
movement,
few stocks have premiums that far out of the money. That is just.
I agree. I agree with that, but Tesla is extremely liquid, right? Yeah. And an extremely popular company to trade. Gino, I'll tell you, I'll be direct. I'm pulling some off the table if I'm looking at Tesla here, and I'm saying, okay, let me reestablish a trend. Let me reestablish a nice pattern. Well, and I could see a lot of great patterns developing here if the 9 EMA holds, Gino, and you tighten up this range.
Yeah.
Oh my goodness, you could have a spectacular technical. And so I'm not seeing this as has anything to do with Elon. I'm seeing this as a little bit of slowing momentum over the last 2 days. It's shockingly a slightly increase in volatility over the last week or so. And so I'm seeing a little bit of volatility shifts. And then obviously when Elon starts talking about stuff, it just becomes gappy and throws off the technical analysis. So I'd like to see that calm down as well. But again, keep an eye on it because it's the first gap down, guys.
Yeah. That's what you just said. Traders do not like gaps, especially when it's news related. That's what causes a gap usually. It throws off your whole, especially for the big traders that really trying to, put their tight stop losses. Nobody likes gaps. Nobody likes news driven stocks. Nobody likes uncertainty. We're just hoping he doesn't do that again in the future, right?
Yeah.
So,
well, good luck to that one.
Right.
Good luck to that one.
Yeah.
And you know what though? A naysayer would say to me what I just said about what he puts out there on Twitter, saying, would we be talking about Tesla today if Elon didn't do those things 10 years ago, 8 years ago, 6 years ago, 4 years ago, 3 years ago, 2 years ago, 1 year ago? It's like, right. It's kind of what makes the man the man. And so you take a lot of the good with a little bit of the annoying factors, and you just take it for par for the course. Last stock I have in the news here today, Gino, and then I want to talk a little bit about another edition of Ginos Gems. AMD here, going like gangbusters, continuation momentum. Look for secondary scenarios from a technical perspective, but the news was very, very, very positive. They want Facebook as a customer for their chips. They also announced a new round of chips during an accelerated data center premier keynote address over the weekend as well. You're seeing AMD fly here. Semiconductors have woken up. A lot of buyers thirst here, Gino, not just for AMD but for semiconductors as well. Just wanted to give that news, Gino. Now, you've been watching the Halftime Report presented by Taco Trading. If you like the show and you like Taco Trading, give us a nice little like and share on the Halftime Report. We really appreciate those. But also subscribe to the channel as we navigate the markets on a daily basis in the Halftime Show. And for those of you new to Taco Trading and new to the market in general, if you're a little green, if you're a little new, this event is for you with Coach Greg Old Money Holmes, Understanding Market Funds, later on tonight. You can click that link. I know Coach Tim has it in the YouTube channel. Set a reminder, and you can come join Coach Greg and myself as he talks a little bit about mutual funds, exchange traded funds, market index funds. He's going to talk about the fees associated to each. He's going to talk about performance metrics and how for new traders, old investors know this. They know the value of ETFs. They understand the fee structure in mutual funds. But if you truly do want to keep all your money that you work very, very hard for in that retirement account, you first have to understand what's in it. And for those new traders, a lot of that is mutual funds as tied to 401ks, IRAs. And so Coach Greg's going to do a wonderful, masterful job tonight of breaking down those market funds and types of funds. So definitely get ready and get excited for that show with Coach Greg for another edition of the Tackle 101 series, Understanding Market Funds, tonight with Coach Greg and Coach Matt, myself, Gino. On to you, brother, for another edition of Ginos Gems.
It's that time. It's that time. And I got a good one. So I'm going to bring up my screen here and share with everybody. This is a Ginos Gem. You know, this is just, every trader has their ways of making life easier and making the routine easier. That's what we call trader hacks. Today, I want to talk about RSI, invented way back, I believe in the 70s by a gentleman named Wilder. This is something I use every day and for many years, since I've been trading for 20 something years now. I really like this indicator because it helps me organize a lot of things, which I'm going to show you. The relative strength indicator usually defaulted on most brokers and softwares to 14 days. You can manipulate that, but you can just leave it there at 14 days. It works fine. It's basically a scale from 0 to 100. It's just an indicator I'm going to add to my charts. I'm going to add to my portfolios, and I'm going to add to my screeners, and I'm going to add to my watch list. I use it as a categorizer. I use it as a way to organize my different charts and everything from strength to weaknesses. Simply how you read this, here's the hack, here's the gem, is when I see an RSI above 55, that means 55 to 100, it's almost always, like 99% of the time, bullish. You're going to be seeing a bullish trend on that stock. Okay, so anything above 55, and also it's a decent uptrend. It's not a slow uptrend, because as a trader, I want a strong uptrend. I want something, you know, they'll say, yeah, anything above 50 is bullish. No, 45 to 55, that's considered neutral and not enough trend bullish or bearish. It's just kind of boring. It hasn't made up its decision. So after looking at hundreds of thousands of charts, your best, strongest trending stocks, they'll hold a 55 RSI and up. They'll stay in that overbought RSI for a long time. The ones you want to look at are the ones that are above their 20-day moving average and holding that 55 and up. They're not touching the 45. You don't want these guys here. So why waste your time looking at these? Because it's going to be a hard decision if you're looking for a bullish trade. Finally, below 45 to 0, that range down there, it's almost always bearish. It's almost always bearish. And it's not a decent uptrend. It's going to be a bearish trend. So here's the hack, guys. When you sort your list to make life easier and save you a ton of time looking at charts, use an RSI. There's a lot of things you can use. Some people use PE. Some people use moving averages and they sort it by that, or industries. It's so much easier if you know what your goal is to use RSI. So again, RSI above 55 bullish, RSI between 45 and 55 neutral, below 45 bearish. Watch how easy this is and how easy it makes my day. Here's a portfolio, but I'm going to show you how easy my top-down approach is. This is sick. My indexes are sorted by RSI. You can load it up here. And right now it's not loading because I have to stretch this out. But you can see that the indexes will be loaded by RSI and they're sorted by it. So you can see right now the NASDAQ, of course, very bullish trend over here. If you get down to the FXI, very bearish trend because it has a lower RSI. And they're not loading right now because I have to reload my broker. But you go to technology, very bullish RSI. You get down here to like communications. It's more of the 51. And you can see down here, see it's 51 on the RSI down here, and so on and so forth. So sorting it by strength to weakness really, really, like honestly, my whole style was basically anything over 55, I'd circle it, and that's the sectors I'd go look for stocks. So once you do that, you know where the strength is. You pull up, let's say, a watch list. I pulled up technology here, and there's 58 stocks. To save time, I don't want to really go through 58 charts looking for a bullish trade. And if I go here and kind of glance through these charts, let me just show you the charts here. You can see these are below a 45 RSI. They're bearish. I'm looking for a bullish trade because this is a strong sector. These stocks are not bullish. I'm wasting my time looking at these stocks. But if I come over here and say, let me sort this by RSI, anything above a 55, which you've got 2 pages of them here. Let me get rid of the ads, of course, and whatever you use for your screener. I got 2 pages or 38 stocks above 55. With that said, I only have to look through 38 stocks because those are the trends I want. Now, when I come over here, watch, you'll see these are all bullish trends. These are all bullish trends because they're above a 55 RSI. I know I've got 2 pages of them. I could come in here and real quickly know that I'm going to see bullish trends. I don't need to look at neutral or bearish trends. I could look at bullish trends. I could see stocks that all have a possibility of breaking out. Here you go. Here's a breakout right here in MU right there. So here's discretionary. A discretionary 82 stocks in my personal watch list. I'm not going to look through 82 stocks. These guys are all below 55. That's a whole page, 20 stocks I do not need to look for. I'm going to sort it. Once again, last demo here, last little example. 82 through 67, I know these are all going to be bullish trend. Almost always. So I go to basic, and here we go. You can see these are bullish trends. You can see these are bullish trends. Now, why am I in this sector? Because these sectors have an RSI over 55. I'm in a strength sector with a bullish market, looking at only the bullish stocks. That's the theme today, is sticking with strength, sticking with bullish trends. And here's your breakout right here in Mattel, about to happen right here. And I'm looking at all bullish stocks, not wasting my time with bear stocks. This isn't a bottom fisher market, so I'm not looking at stocks I need to bottom fish on. Again, sorting by RSI. That is the Ginos Gem today. Thanks, everybody. Appreciate it.
Gino, thank you so much. Love the RSI from an indicator perspective. It allows us to understand overvalued, undervalued conditions from a technical perspective. When RSI is above 50, even if the 8 is 70, 80, 90, you might be a little bit overextended range up, but those are very healthy bullish trends. And Gino, just on that, just while you were going through it, I was like, okay, that has momentum. Nice high base. Looks like a trigger. Yeah. I love the simplicity of it. Gino, thank you so much for another great edition of the Ginos Gem. I know you
look at thousands of charts a day, Matt. We can look at 1,000 charts on a Friday, right? We don't want to waste time with ones that are not trending. Why even waste our time? So only look at candidates.
I agree 100%. You've been watching another edition of the Tackle Trading Halftime Report. It's been an absolute pleasure to break down all the market activity every single day here today. We do it every day, though, so come join us every day as we navigate these markets together, as we go through the indexes, the sectors, individual stocks, news of the day, earnings, and obviously on a Monday, another edition of a Ginos Gem. Tonight, we have onboarding with Coach Frank, but for the most part, we are getting excited for that Tackle 101, Understanding Market Funds with Coach Greg. I've just gotten the PowerPoint from Coach Christian, and oh wow, it looks beautiful. I'm very excited for what Coach Greg has on tap for us tonight. So pro members, obviously going to be a little bit of a recap because it's very basic, very introductory content. But again, we have a lot of people at Tackle Trading that are newer to the markets that maybe don't have that same understanding of all these different products in the marketplace. So get excited for Coach Greg for another edition of Tackle 101 later on this evening. I'll be there with you to do his introduction and just to be a participant like you guys as well. So looking forward to that here tonight. We'll be back with you at the same time, same channel tomorrow from the Coaches of Tackle Trading. We'll see you tomorrow.